If you guys have not heard of the Enterprise Investment Scheme, then keep on watching because the UK just quietly doubled the investment size of one of the biggest tax shelters in the world. So what actually is the Enterprise Investment Scheme? Well, from now on I'll call it EIS just to shorten it down a bit, but it's a government-backed scheme to encourage investors to invest in small UK businesses. The cap has just gone from a £15 million company to a £30 million company, and the idea is to help small UK businesses raise startup capitals. And because these small businesses are a slightly more risky asset, what it does is the UK government incentivises this by offering massive tax discounts. So if you win on your investment and the company does amazingly, then you win tax-free, and even if it fails, the government cushion you by offering massive tax relief. There has been 3 big changes within this system. I do have some notes in front of me just to make sure I don't forget any of them, but let's start with number 1. So the gross asset limit of the company has gone from 15 million all the way to 30 million, so it's doubled in size. This is so important because obviously a 30 million pound company is going to be more stable and have better projections than a 15 million pound company. So what it means for investors is that the risk is just halved in size potentially. So this really helps broaden the companies you can invest in whilst classifying for this scheme. Number 2 is companies can actually raise 10 million a year from this scheme rather than the 5 million originally. So companies that are within this range of up to 30 million pounds value, they have double the amount of money they can gather from this scheme. So they're going to be looking for more investors, like wealthy individuals, like the people that this scheme applies for. So it just means that there's more money on the table and more investment opportunities for you guys. Number 3, I will be reading this off because it is a bit wordy and I might start stuttering and it might confuse everyone. But so obviously there's venture capitalists in this industry, in this investment scheme, because it's small businesses. Venture capitalists put money in to get high returns. That's what venture capitalists are. So obviously before we were competing a bit, being an investor in a small company with venture capitalists. However, the 3rd change will help investors like ourselves and actually make it worse for venture capitalists. So what the change is so the tax relief cut that we get and venture capitalists get was 30% for venture capitalists, but this is cut down to 20%. But for investors in this scheme, so wealthy individuals under the EIS scheme, keep the 30% relief. So this really does move money away from venture capitalist funds and into the EIS investments. So I'll say it one more time, just clearly. The income tax relief is 30% for EIS schemes, so for us, and 20% for venture capitalists. So now you guys know exactly what this scheme is. Let's talk about the tax benefits, because it absolutely blows my mind that even if you make a bad investment in a bad company, this still can be beneficial, really, really beneficial, because of the tax relief the UK government give you. So let's get into all the tax benefits so you guys can fully understand this scheme. Number 1 is 30% income tax relief, up to £1 million. So if you put £1 million as the investment into a company in this scheme, you get 30% slashed off your income tax bill. So you put £1 million and you get £300,000 you can automatically deduct off your income tax, which is absolutely crazy. That's pretty much straight away a 30% gain on your money, a 30% return. That is the first one, and that is crazy off the start. Number 2 is 100% of the money you make from the company, if the company grows, is completely capital gains free. So if your £100,000 investment goes all the way to £300,000, the £200,000 gain is completely tax free. Again, absolutely crazy. This 3rd one, I've got a pen and paper just to clearly write it out for you guys, is capital gains deferred relief. So you can freeze a tax bill from a different asset liquidation. So let's say I bought crypto and I bought £1 million worth. I make 20% back. So I've now 20% gain and I've got 1.2 million. Obviously, now I've got capital gains tax tax to pay on the £200,000 profit I made from that investment. However, instead of paying that tax now, so let's say it's 40% and I have £80,000 to pay in tax. Instead of paying that £80,000 tax now, what I can do is invest in the company. So I put the £200,000 profit, £200,000 profit into a company that qualifies for this scheme. So I put it in a company, within this scheme. So obviously under, as I said before, 30 million. And now you do not have to pay capital gains tax until, so let's say you've done this, the investment then goes up 20%. So now the tax you would have paid is actually working for you. So instead of paying the £80,000 tax up here, you've put the £200,000, which was the profit from your crypto investment, into a qualifying company under the scheme. So now instead of paying the tax, you can delay this tax indefinitely whilst you're not paying this tax. Now it's actually working for you. So the tax you would have paid is actually working for you, and it's got a 20% gain. The 20% here, which is 40,000, is obviously tax-free because it's under the scheme. And then the £80,000 tax, which you should have paid here, so let's say we sell the company, we've made a 20% gain, you then have to pay the £80,000 tax. So what we've done is just delayed the capital gains tax from this investment, delayed it all the way, put it in another investment, made money off the tax we would have paid, and then you pay the exact same amount of tax once you sell the company, the shares you have in this company. I hope that makes sense. But it does keep on going because it's an indefinite process. So now we've still got £80,000 to pay tax at some point, but we've put it in the company, we've made 20%. Now I've got £240,000. If we sell this, obviously, again, the tax man's going to be like, we want £80,000, but you'd be like, hang on a sec, there's another company I want. So now we've made £240,000, but now you put this straight into another company, which qualifies in the scheme. And what that means is then you still don't have to pay the £80,000 tax you have from this crypto. This could be crypto, this could be selling a house, this could be stocks outside your ISA. Any asset you have to pay capital gains on, you can follow this process and delay the tax bill. And whilst that tax bill is delayed, you're making money off the tax you should have paid. So when you sell this company, and then again, we've got the £80,000 tax we never paid at the start, but you can then put it in another company that qualifies for the scheme. So then we have 240, and the process repeats again. Then you can make another, let's say 10% this time, so another 24, so 264,000, we made 10%. Tax mass for 80,000, you can say, no, I'm going to put it in another company, and the process repeats and repeats and repeats, and your tax bill all the way from up here can be delayed for as long as you want, as long as this process continues. The third tax benefit is to do with inheritance tax. So if you guys hold the company within the EIS for over 2 years, I wrote down here, then actually it qualifies for something called business property relief. So if you pass away and those shares get passed on to your beneficiary, entirely tax-free. So you do not have to pay the 40% inheritance tax. So again, this applies for if you hold these shares within the scheme for over 2 years. I think this is the fourth one, is actually if you lose. So if the company goes completely bust, you can take out your net loss and claim it against your tax that you're paying. I think it's the highest marginal income tax bracket. So I'm going to get some pen and paper out again and just break this down for you guys, because even if the company goes bust and you're a higher rate income taxpayer, you've still made 60% on your money. So let's break down the numbers. So let's say you invested £100,000 into a company, but the company goes bust and your £100,000 goes to zero. If you guys are a higher rate taxpayer in the UK, you're paying 45%. I know, crazy. But you can claim the whole £100,000 investment off your tax bill. So now that's £100,000 off your tax bill. But pairing this with the initial 30% relief we got off when we did this investment, that works its way up to 55% anyway. So you're so protected even if the company goes bust. There's so much tax relief here. Anyway, I hope that helped you guys. It seems to be the ultimate higher income playbook. But if you guys liked the video, please subscribe and like because it would help me out. Thank you guys for watching.